Good morning and welcome to the Monday Market Update. This is Nash Paradise live with my buddy Andrew Cady. The very first Monday of 2026. Andrew, how you doing this morning?
Doing amazing. Welcome to 2026, folks.
I've almost said 2027 a couple times. I feel like we've had 2026 on the brain here for a while. We've been talking constantly about what's happening in the 2026 market. Where are rates going? How are they going to finish out the year? I feel like we've kind of been in 2026 for a while, but that's a me problem. And speaking of last week, let's talk about what happened here. So what a nothing burger looks like. Any other commentary you'd add other than no one cared about anything last week?
No, I mean, listen, it's always this way towards Christmas, New Year's. Everything slows down. Trading volume was actually pretty good, but it still impacts, very little change in mortgage rates, very low volatility. Call it a flat week. 10-year Treasury ironically rose during this time, but mortgage rates kind of held their ground a little bit.
Yeah, they seemed a little unfazed by what was going on. It's funny. We look at, trading volume and volatility. The fact that by, 10 a.m. Eastern today, we've already surpassed the trading volume that we had on both December 23rd and December 26th, which were full trading days. It shows that we're out of the holiday mode and, we're going to see a lot more interesting things happen this week. But let's talk about what last week's data looked like, if there was anything interesting that we wanted to see here. And you normally think the jobless claims would be, kind of a market mover. We've been talking a lot about softening in the labor market, and here we are with jobless claims coming in low again. What do you make of the, lower figures here on the jobless numbers?
I think it just continues the trend we've been seeing now. And really the trend that's going, really, really strongly. I mean, the updated QCEW data shows this weakening in the labor market. It shows it on a massive level. I believe it was a 2-quarter window. We added 1.02 million part-time jobs and lost 984,000 full-time jobs. It's just continuing to emphasize weakness in the labor market.
Yeah, the labor market is weak. We know it's weak. Unemployment has moved around, yet, there are fewer people, starting their initial claims. There are fewer people doing continued claims right now. And, it is what it is. There's a lot of jobs moving over to part-time, like Andrew said. And so we're not necessarily seeing all the data hitting in the same way that we would expect. And that's why we're not seeing a lot of movement. But again, last week, short week, very, very low trading volume. This week, we're hoping to get some more aggressive stuff going on. It's a packed week. It's a busy week. Got a lot of stuff here. A couple things that I would point out. I'm really circling Friday. Friday is my big day. We've got non-farm payrolls, unemployment rate coming back. I feel like we just had that. But, it was a matter of getting late data, catching up with the BLS and, the holiday break. What are you anticipating, considering that the non-farm payrolls figures are only showing a forecast at plus 55,000 and an unemployment rate dropping from 4.6 to 4.5%, given our current trends and trajectory?
Given current trends and trajectory and maybe the fact that the BLS is actually waking up, to me, 55,000 with the numbers we've been seeing isn't a hard number to beat. And I think the real kicker with the jobs report is going to be the revisions of the previous reports. If we continue to see a trend of revisions lower and we go from negative to further negative or slightly positive to negative, that is going to impact markets as well. For me, I agree. Friday is going to be the big day. We got a lot of stuff coming out, but we also have the consumer sentiment index, and that's going to be a market mover. Manufacturing PMI on, what is that, Monday today?
Yeah, we've got ISM on Monday and ISM manufacturing PMI on Wednesday. So you got a couple different manufacturing indexes coming in, which, yeah, they don't seem to have really mattered lately in the last few sessions anyway.
Right. To me, very little is mattering right now. I mean, we should be seeing markets move extremely strong, favorable to mortgage rates right now, but there seems to be a bit of a stalemate on it.
Yeah, there's absolutely no good justification. The data that we've had in the last couple of weeks would support 10-year treasury yields being much lower. This holding pattern in this 410 to 420 in the 10-year treasury is kind of obscene and really frustrating. When you get the data, you get everything you're looking for, and the markets aren't moving. We'll talk about that a little bit later on what some of those causes could be. Let's take a look at the Fed projections here. I believe we got this next. We've been watching this for a while. This used to be the most interesting slide of the day. What's going to happen with Fed funds? I feel like we're in that nice boring zone, which is great, which says, hey, no cut in January. And then somewhere in that March, April timeframe, we're getting another, and then we're getting one more. Who knows when that's going to be, but it seems like we've pulled back just a little bit on the timing on those cuts where, I would say April and July are looking more favorable than what we had before. Anything new that you'd point out on here?
No, I would say the first cut to me is becoming choreographed for April. Obviously, markets are going to dictate it. If things would continue to deteriorate rapidly with the labor market, that could come sooner. But right now, I would say a safe bet would be first cut in April, and I still am leaning towards July. But again, I wouldn't put. There's only one meeting from that April meeting to the July meeting, so it wouldn't be a surprising move if they do a cut. Labor market tends to stabilize if that second rate cut pushes out to September, potentially October.
Yeah, I think it's interesting that despite the last three cuts, we've seen no real movement in the floor on 10-year treasury yields, which is surprising considering what we'd seen on previous cuts is, those 10-year yields would follow. It feels like they are sitting up on this high shelf waiting to come down and absolutely not breaking through. I feel like as we get into March, if we stay in this close to 50-50 range, that could be a little troubling. You could see markets pull back a little bit on where they're throwing their money if it's not, a far from a foregone conclusion what the Fed is going to do. I don't like the fact that it is so, up and down on March, and all the projections that we've got coming up with it in regards to labor, CPI, they're very conservative. They're low. I mean, we are anticipating low action on the labor market. And so that leaves a lot of room to miss high, which is not necessarily good for a given direction to the Fed. I don't like a lot of what we have coming up in the next, 4 to 6 weeks as we get closer to that, January meeting. The FOMC minutes after that, I think, are going to be really important, really telling. I'd like to see that March move one way or another and not be so 50-50. It's been a while since we've been, kind of either or on a Fed drop, and we've had so many. We don't need to be 50-50 on that. I would love to see it push out to April, but we'll see. They don't listen to me. They probably subscribe to the podcast, but they're not following along. All right.
Yeah. The other thing that will be interesting on this chart is as we get towards the end of January, we have a Fed meeting, but Trump has said that he will make his nominee for Fed chair in January. And I would assume that will probably be in Trump fashion ahead of that January Fed meeting. So it'll be very interesting to see who is nominated and how this chart reacts to that. Because if you get a very, very hawkish Fed in, we could see this chart completely flip on its head. If you get a dovish Fed in, we could see this chart flip on its head. If we get a hawkish Fed in there, it could be interesting. I follow a lady called Danielle DiMartino Booth. She's a former Fed insider, and she penned an open letter to the FOMC, basically asking them at their January meeting to nominate their own chair, which they have the right to do, and basically block Trump from, she calls it meddling with the Fed. So I do think we're setting up for potentially a little bit of a battle of what we could see as a new Fed chair.
Yeah, in battle, that news cycle could be interesting. It could impact the way investors are moving money. And, we'll have to just kind of take that Monday after Monday and see, what's going on with that and, what kind of news we get from our current administration and our current Fed. So let's talk about what that means for rates right now. The great nothing burger of Q4 2025 into Q1 of 26. We have just been slow, steady, and flat, which is not bad for mortgage professionals. Although, again, like to see some a little bit of relief here, given the three cuts that have happened afterwards. Anything else you'd add to these flat, boring mortgages holding in range?
I don't like the way this chart's trending. If you see the down drop right after September 2025, that was in anticipation of the first Fed rate cut. The
Mhm.
one right before November 25, that was the drop right in anticipation of the next Fed rate cut. But we don't see that level of a drop for the third Fed rate cut. And we definitely seem to be a bit range bound, although the tail end of this chart is starting to move its way down. Now, if you drew a line from where we're at now and you drew that horizontal line, that's going to line up with a lot of those bottoms. So I do think the moment we're at right now, about a 6.2%, is a very pivotal moment. We need to break lower than this to continue that trend line lower, or we're going to remain range bound here.
Yeah, and the funny thing, if you overlay this with 10-year yields, you just look at the spread, which we talk a lot about. Right now we've got the 10-year yield at 417 and a 30-year fixed at 620. So we're 2.03% away, which sounds about right. And that is about right, but we've been trending closer to two and a quarter ish. So the fact that 10-year treasury has not moved and mortgage rates are starting to settle down a little bit, we're compressing that margin into that 2% range where there's not a lot of room to get better from there. We've been much higher than 2%.
And 3% at one point.
Yeah, so it makes me not nervous but a little apprehensive that what we have taken where rates have softened is not directly correlated to seeing a 10-year yield drop below some of these thresholds. We really need to see it move, especially that 4.0. Like, we need a 10-year treasury yield in the threes, and that's going to move things and I believe start a chain reaction where we can get some of this relief, putting us into our forecast for this year, which say we can absolutely hit in the fives on this 30-year fixed overnight average. We're only 20 basis points away now. Can we get down there? Not without help from the 10-year. So this chart, as we've said before, and as we've been in for a while, a lot of nothing on mortgage rates, but we do have a slightly increasing 10-year yield, which, I guess I could say the positive there is we do have room for that 10-year yield to drop, pulling mortgage rates down with it. Anything else you'd add?
I think that's it.
All right. So I want to hear from you on why do you think we may be in this range where nothing matters? Data is no longer our dependency. Investors are, keeping their bond purchasing to a point where these yields are staying high, a very, very low trading volume. I know you'd read something and gotten some feedback on possibilities for why markets just aren't responding in the way that we expect them to. And I was hoping you'd share that. We could talk about it a little bit.
Yeah. So to me, I mean, we see the data. Money is not moving to the sideline. Like, cash reserves aren't necessarily increasing. So the money that would normally, so when the stock market is troubled, there's a flight to safety. When something happens like what happened in Venezuela, that would typically trigger a flight to safety. A trigger, what does a flight to safety mean? It means people pull money out of stocks because that's very, very volatile. They put it in bonds. They go to treasuries and they go something more safe. And we would typically see a big run downward on the 10-year treasury this morning, but we're not seeing it. And I tend to think that the market's a little drunk on a couple things right now. I think AI stocks, we see what's happening with them. And I think investors are hell-bent on continuing to push capital that should be coming to us into bonds, into AI stocks. But I also think it could be compiled a little bit with the crash that we saw in cryptocurrency. We saw Bitcoin drop from what was at 122,000 down to 80,000. A lot of investors saw that as a massive buy opportunity. They saw it as not a halving, but pretty dang close to a halving. And if you get to that point where people have cash to push that would normally be pushed to safety, but there's opportunities they perceive as long-term investments that are still going to be somewhat safe, I think we're just seeing money being moved to areas where people are a little drunk on big returns rather than safe returns. What's your thoughts, Nash?
Yeah, I mean, it's hard to disagree with that. There's this numbness in the markets. The stuff with Venezuela should have absolutely shot money into treasuries, but I feel like there's, you know, the sense of urgency and the fear that usually comes from that sell off and that purchase just kind of don't exist right now. I don't know if everyone's just completely numb or if it's the fact that retaliation from China, Russia, North Korea, et cetera, that it's not any real meaningful threat. No one's gonna really do much about the U.S. going in and taking the leader of Venezuela. It would normally move the needle, but for whatever reason, markets don't care. There's something that they like more. There's something they like more than jobs. There's something they like more than inflation. It does seem like AI is that popular ticket right now. Money is staying there. I think that combined with just end of year softness anyway, everyone's got their balance sheets in order, but now it's a new year. It's a new week. I think what we're looking forward to this week is, are we going to get some of the volatility that we would normally see with important data, with bonds holding up levels that they really shouldn't be held up on given our current Fed funds rate and recent data that we've had? I don't know. We'll see, but this is definitely a week to be watching that. Any final thoughts you got?
Yeah, I mean, to say markets aren't reacting, I mean, they are a little bit. We closed at 4.195 on the 10-year treasury, call it 4.2 rounding, and we're rounded at a 4.17 right now, but that's a pretty strong floor of support. So we're testing that. If we can break below 417, our next stop is a very, very strong floor of support, which is 412, 412.5. You have the 25-day moving average, 50-day moving average, and a Fibonacci level there. So I think we're trending a little bit in the right direction this morning, but until we actually see meaningful data that helps us, I don't think we really break those floors. And so this might be a slow week on mortgage bonds or on treasuries until we get the Friday data. And the Friday data is going to actually be pretty important, because if we're sitting right on a floor and we get our bad jobs report, we're going to crack below it. Like, that'll be the catalyst to move us. If we get a gangbusters jobs report, wouldn't surprise me if we saw in excess of 4.2 on the 10-year treasury and rates go back up again. So everything to me this week rides on jobs data on Friday.
Yep, completely agree. Friday is the big day. Wednesday is like a little mini day. We may know more about Friday on Wednesday when we get ADP jobs, when we get JOLTS, when we see how the second ISM manufacturing PMI data comes out. The one from today was a little bit low. Maybe the markets care about that, and that's why they're moving. But it's going to be an interesting week to see what happens with all the activity going on, and maybe we get to some normal reaction on our data-dependent cycles. So check in with us next week. We'll see what happened, talk about what's going forward, and keep you informed with what you need to know to help your people here in the real estate world. I appreciate you, Andrew.
Take care.
Have a good one.